Welcome back. We now have the pleasure of welcoming Lara Dalmeyer from ABAX into the studio on the Flexible Income Fund. Lara, thanks so much for joining us this morning.
Thanks for having me.
Full disclosure, fixed income is not my area of expertise, so if I do ask any naive questions, be gentle.
No problem.
But we shall learn as we go. Maybe a good place to start is just on the recent performance of the portfolio.
Sure. We've given a bit of a breakdown of the performance of the fund on the slide that you can see. The yellow bars show the performance of the fund for the last year. The top line is the total gross performance, and then it's broken down into the various asset classes. The green bars show the same for the last quarter. I think we've been very happy with the performance of the fund over the last year, and I think the main message that we want to show here is just how diversified that return is being generated, that you really are generating this income from a variety of different income assets, not just from one or two. But the 31st of March was a long time ago, and a lot has happened since. So yeah, I think there are certainly more interesting things to talk about than performance of the fund till March.
There certainly is. This is a Q1 report back, but we'll be
the first week of April was much more exciting than the whole of Q1.
Exceptional times.
Yes, for sure.
But I want to tease out something that we were chatting about before we went on air today, was around the dollar's position as a reserve currency, because I know you had some interesting observations on that. Trump came out almost saying, don't threaten the dollar as its reserve currency, but what he was doing was almost contrarian to that message.
As much as this is a fixed income fund, what's happening now is so focused on economics, and I always go back to Stephen Moran, one of Trump's advisors, published a paper last year. And it was a very interesting paper where it laid out, how do they see the world, and what are the real problems that they foresee, or that he foresees for a Trump administration, and what are the different ways in which they can resolve these problems, and what does he think will be priority for President Trump to resolve these issues. And it's amazing just how quickly this has played out. And essentially, what is driving this whole trade deficit issue that the US is trying to resolve is a very natural dilemma that faces a country when you are the global reserve currency of the world. As a matter of fact, it's quite a popular problem called the Triffin problem. And what this problem describes is that as being the reserve currency of the world, you have a lot of benefit. For example, you have access to cheap financing, you have a lot of control over the financial system of the world, but it creates a lot of demand for your currency. And currencies are essentially what drives the whole, or the entire economics of the world. And natural currency appreciation and depreciation is necessary. If you think about a country that exports a lot, it generally makes their currency quite strong, and vice versa. What's happened with the US, and when you are the reserve currency of the world, this unnatural demand creates unnatural currency strength, which means that from an exporting point of view, they are no longer competitive. And quite interestingly, the Triffin problem attributes a number of other criteria that can be slight unforeseen consequences of this is when you have a decline in your industrial base and in your manufacturing base, you are often at some point having to supplement that side of the economy, which can create quite large fiscal deficits, and that we have come to see. So not only are you struggling with large fiscal deficits, you're struggling with large trade deficits, and the Triffin problem essentially says that this is ultimately the demise of the reserve currency, where these massive deficits start to create credit uncertainty. So it is a real problem, and it is, I think, a very viable problem that the Trump administration has singled out and needs to deal with in a way. But the way in which they have decided to deal with it so far has proven interesting.
And I think they might even use the term threat, not problem. It is a threat.
Exactly,
right? So that really gets used a lot. But I mean, a couple of points as you're talking, it sounds like there's almost cognitive dissonance where you're trying to believe opposing things at the same time. So
yes,
we want to remain the reserve currency, but we'd like to be weaker as a consequence. So it's artificially strengthened the dollar based on everything that you said, whereas other nations' currencies are moving in line with the risk premium of that country and what they're trading, etc.
Exactly. So tariffs are, I think everyone kind of laughs when they said, well, of course tariffs are a tax. Of course it's inflationary. The truth is, though, that, the beautiful economic theory behind tariffs are that they don't have to be inflationary, that they are naturally currency appreciating. So in a perfect world, if the dollar was to strengthen enough to offset the tariff, the US consumer wouldn't feel that, okay? But we know that that is not the case. The way in which this has been implemented has created so much market uncertainty that the dollar has really fallen out of bed. So yeah, as you say, there are a lot of contradictions where you are using currency appreciating measures to deal with this problem. But you are also convinced that this is not going to harm your consumer, but you can see what is happening to the dollar. So yeah, as I've said, it's really is quite a lot of contradictions coming through in policy.
And I know we're having a lovely chat, but believe it or not, there are slides
yes,
that we are moving through.
Yes.
But I mean, heavy wears the crown of being the reserve currency. I think is also what maybe is underappreciated there.
Yes.
My question is, and this came up in our session earlier with Rashad, is this tension between if you Powell and you're making decisions on interest rates in his committee, where does your prerogative lie? Because again, there's two things happening here. There's the inflation upside, which economic theory will tell you, okay, well, you need to keep rates higher.
Yeah.
But at the same time, you could be heading to a recessionary environment, which means keep rates low if you want to come out of it. So how are they sort of navigating that, and what is the message that you're getting from markets? Because it seems to be moving.
Sure. I wish I could answer that question easily, because I think the message that we're getting is very mixed. The Fed's messaging, if I can point you to this slide, the Fed's messaging has been a little bit easier to decipher since at their last meeting, where it certainly seemed that they were putting more emphasis on the growth concern than the inflationary concern, okay? So yes, they revised their inflation expectations upwards, they revised their growth expectations downwards, but they used that magical word again, it's transitory. So I think that for me certainly was an indication that they are going to react more on growth concerns than what they have convinced themselves are transitory, once-off inflationary pass-throughs, which perhaps they're right, but just remember, as you see persistent dollar weakness, that inflation persistence remains. So as soon as these tariffs were announced, you had an incredible rally in US Treasuries. So the market very much had my view that yes, the Fed's just going to have to react and react quite quickly. You can see that the market, even up until now, is still pricing in 3 to 4 interest rate cuts this year, but you have seen quite a significant upward reversion, particularly again in like the 10-year space, in the longer end of the US Treasury curve. So what is that signaling to us? It's either signaling to us that all of a sudden the market thinks the inflationary concern is a bigger concern than the growth concern. I don't think that is the case. Or it is signaling some dislocation and some issues in the bond market, or let's just say bigger market liquidity events where there is a lot of US Treasury selling. Or there are even the theories that it is other sovereign nations selling reserves as a countermeasure to what they view as an attack.
The challenge is trying to get to the bottom of the rationale behind some of this movement, because I mean this chart suggests, as rate expectations go up, it means the market's assuming that inflation will become increasingly important, and recessionary less so. But let's see, it looks like a bit of a ding-dong battle.
The Fed is, that saying, stuck between a rock and a hard place. It couldn't be truer for anyone but the Fed at the moment. So, yeah. But if I had to be a betting person, I think they're gonna react on growth more than inflation at the moment, because I think they've got a story on inflation,
which the markets would probably appreciate a little bit more.
Yes. This is a different sell-off, though, to what we've seen previously. You know, in general, like risk-off environment, there is this flee to the risk-free asset. This crisis is different because the risk-free asset is being brought into question. Are US Treasuries still the risk-free asset of the world? We've seen the concern around their fiscus. We have seen what certainly have so far been unsuccessful attempts to cut expenditure. As a matter of fact, if you look on the Department of Government Efficiency website, that 150 billion or so they claim to have saved is pretty much just what the government has overspent this year. So they've essentially done nothing. This is a different crisis in that way.
Yeah, I mean, it's curious using the word crisis. I think if it is transitory, I think time will tell.
Yes.
And the markets suggest, you know, us millennials that have been in the markets for 20 years, this would therefore be our third crisis,
yes.
which is unusual
exactly.
in and of itself. But let's bring the crisis back home.
Yeah.
I don't even know if it's a semi-crisis. I'm not sure what to call it. But you have views, because the South African sort of government bond market actually reacted very contrarian to everywhere else in the world.
Yes.
And maybe you have more insights for us on that.
Well, as US Treasuries were rallying and as other EM bonds were rallying, and I'm sorry, that is a very messy chart, but essentially you've just got to look at everyone else. All other EMs and US Treasuries are all the other colors, and then South Africa is blue. So our yields were rising over this volatile time while other yields were falling. So while everyone else was saying, okay, yes, interest rates are going to come and they're going to come quite a bit quicker, our yields were essentially taking in a lot of this background noise, but more importantly saying that what's happening off of the back of the GNU and a bit of difficulty around that the risk premium just needs to be that much bigger. So we saw massive upward revisions in the implied South African risk premium.
So if you think of the flow of capital as a zero-sum game, is this money being pulled out of SA from foreign investors, would you say?
Oh, geez, foreign investors haven't been, I would say, recently they've been bigger buyers. So I would say probably across the board, but maybe that I think a lot of the confidence that, you know, foreign investors needed to start reinvesting in local markets was probably taken off the table quite quickly by jitters between the ANC and the DA. But again, this is a few days old. That's probably why I'm hardly referencing the charts, as our charts have become like stale within a few days.
Fair enough. I think it captures the challenge of being a portfolio manager in 2025 thus far.
Exactly.
I say thus far, so let's look forward to the next 3 quarters.
Yeah.
I know you have a slide on the outlook and some of the positioning, at least from a portfolio perspective.
Yeah, look, ultimately we talk rates and we talk economics, and the bottom line is we don't know, right? Yeah. I think what we do know is that there is a very different administration in charge that have very strong views, and what we can probably bank on is more volatility. And that's probably the only thing that we can bank on. So I do think that this is an environment where diversification is key, and thankfully that is really what we hang our hat on in the Flexible Income Fund. We are a low-risk income fund. We do not take any significant credit risk. We do not take unlisted credit risk. We do not take unguaranteed SOE credit risk. So this is a low-risk portfolio. We are diversified across a large variety of income-generating asset classes, and we really have kept our duration moderate. Thankfully, prior to this bout of volatility, we had taken quite a bit of duration off the table, as we felt that local rates had already moved quite a lot. So we were only about 0.6 years local nominal bond duration, about 0.4 years short-end inflation-linked bond duration, and then 0.3 years offshore bond duration. In the first week of the second quarter, we have sold off a bit of the offshore duration and bought a little bit more into local bond duration, where you did see that quick and quite significant dislocation. What we have also done is sold some dollars. We have reduced our dollar exposure to about 1.5% only.
And is that part of the offshore market, money market component?
Yeah, so those are two very different decisions. We will decide purely on a hedged asset basis whether we like the yield of the offshore asset, and then how much of that we hedge back into rands will be a separate decision, and very much based off of our view of where the rand's valuation is. So at 1950, 1960, 1970, we were selling dollars, buying rands. So our dollar position at this point in time is very low at only 1.5.
Don't forget that it's a reserve currency.
Yeah, we'll see. No, jokes aside, I do actually. I think that crown, they will wear that crown for many a years still to come.
I remember that argument surfacing when the EU was formed.
Yeah,
it's been a couple of decades in the making, and it's shown that.
Yeah, no, I think to substitute dollars and dollar demand, and this is part of their problem, is that you have that inflexible demand for dollars because of how much is denominated in dollars globally. Yeah. So for that transition to take place to any significant degree is decades and decades.
Yeah. And the BRICS won't achieve that, which.
Well, I think that even on a rumor of that, President Trump got his back up pretty quickly. Yeah. So, yeah, listen, they don't want the strong currency, but they definitely want it to be the reserve currency. So, as I say, we're in a period of economic contradiction. So, yeah, the only thing we can bank on is volatility, and we keep the portfolio as diversified as we can to hopefully give people as smooth a ride over what is certainly going to be an interesting year.
Brilliant. Lara, thanks so much for your time today. Hopefully I didn't come across as too naive in the fixed income space.
Thank you.
Appreciate your insights as always.
And Thank you. Keep well.
Enjoy the rest of your day. Thank you.
Bye.